Hi guys, my name is Tyler Redito, financial advisor with Precision Insurance Services Inc. We work with Industrial Alliance. I wanted to make a video for you guys. I had a lot of requests the other day in regards to diversification strategies and equities versus debt and how you can actually use those strategies to prevent you from losing money in the markets. So without further ado, let's get right into it. So I prepared a presentation for you guys to show you guys how you can use equities and debt to combine together to mitigate the risk of you losing money. So basically, what are equities and what is debt, Tyler? Equities are basically a group of stocks that you invest in. So for example, let's say you want to get into an equity fund that has 10 stocks compiled in the fund, and you would put $1,000 in, and there's 10 stocks. You would put $100 into each of the stocks, which is a combined $1,000, right? So you invest accordingly. So if 1 or 5 goes up and 5 goes down, it would average out so you don't lose your money. Now, what is a bond, Tyler? A bond is basically, or debt is basically when you're giving companies money so they can use. They're taking on debt and they're paying you a specified interest rate every single month. So basically, they're basically taking out loans from investors. You are the investor, you're giving them money, and they would give you money every single month. The interest rate changes depending on obviously the fluctuation of the currency exchanges. So if you're investing in the United States and you're in Canada, then how fluctuations in the currency changes, so it would change based on that. Okay, so as you can see there, the average rating of the bond is AA minus, which is really good. It's basically like saying that you're more than likely to get paid, because the more closer it is to A plus, A plus plus, then you're more likely to get paid out, which is a really good. It's basically like a credit rating in a sense. Average coupon is about 2.6%. That's the average rate per year. And yeah, so this is the lead manager, Clement Gignac. He's the fund manager. He's the one that made the fund itself. So it's also very important to have a combination of both in your portfolio based on your risk tolerance. So if you can see here, based on the answers that you provide on the investor's profile, which is supposed to be done by advisors for compliance purposes, let's say you land on a moderate profile. You answer all the questions. I'm kind of in the middle, Tyler. Okay, well, we'd put you in income funds, where most of the funds that you invest with us would go, or with another company would go to income funds. This is more of a safe investment, because obviously, companies who take on debt, they just give you month after month, month after month, month after month. And equity funds are more kind of riskier, because obviously stocks fluctuate more than bonds, depending on, the profitability of the company at that time. So as you can see here, if it's more into income funds, it's more safer, but you won't really make that much as opposed to putting into like aggressive profile into equities, but it's more risky, right? So as you go down the spectrum, you can see that the more you go down here, the more you go above, going above balanced and to growth and to aggressive, more of it would go into equity funds. Obviously, it's a little bit more risky, but you can make more. So obviously, it depends on the risk tolerance of the investor and what they're comfortable with, what they're suitable for investing into, etc., etc., etc. So I also wanted to show you guys, this is different types of investment styles. So, if you're more into security, it would go into this. The legend is here. If you're more into this, diversified income investor, opportunity investor. So it really depends on kind of the strategy, of the advisor, and also on the fund as well, and also on obviously the investor profile. Right. I wanted to show you guys something very interesting as well that I prepared for you guys. Where did I put the fund here? Oops. So with this diversified fund, what's very good to note is that there are a lot of things to consider. Obviously, it depends on the where it's being invested, and obviously the allocation, how much of a percentage is going to equities and bonds. But it's also important to note in terms of diversification strategy and also hedging your bets, it's also important to rebalance this every now and then, because sometimes the equity component can actually get more. Like, so for example, This is 35.96, as I can see here, 35.96. If equities overperform bonds, for example, let's say the prices of the stocks in the fund goes up, and let's say this goes to 50%, it's very important that the advisor and the client as well, they come to an agreement to reallocate this back to 35.96, because that's within the client's risk tolerance. If this keeps going above, it keeps going up 60, 70, then it would be out of your risk tolerance. And if there is, a sudden drop in those equity, then, there wouldn't be enough bonds or an allocation of bonds to kind of hedge that equity drop, or the drop in the equity prices. So it's very important that rebalancing is done every quarter, which is done with Industrial Alliance. It's our protocol. Like if it does go above a certain level, so that's a risk strategy as well. And it should be done. It should be done. So anyways, yeah, that's pretty much it, guys, that I wanted to show with you guys. Obviously, this fund is for medium to long term, and this is for a low to moderate profile. I would not be putting clients into very low if they were here, and I wouldn't put them in a high fund if they were here. But anyways, yeah, guys, that's basically, I wanted to show you guys that, don't be too scared to get into the markets. It's always important that you talk with your local advisor to know what, the best solution is. But this is personally what I do for my clients, and it's what all advisors should be doing. But yeah, if you have any questions, concerns, feel free to comment down below on the comment section. I'll also leave my phone number and my email so you guys can contact me. I'll also leave my LinkedIn and also my Facebook details. You can message me and ask any questions you might have. So yeah, if you guys have any other concerns, just email me, and I can make another video based on what the demand is for whatever topic you want me to make, what you guys want me to make a video on. So thank you so much. I'll see you on the next video. Take care. Bye bye.